All right, guys, welcome back to Fast Finance. We're going to be taking a look at a few of the most relevant stories of the day. So, first off, is just sort of the stock sell off that we had today. This was largely because the Federal Reserve Chairman kind of underwhelmed markets by failing to push back with much effort against the recent spike in Treasury yields. So, it just doesn't look like he's making significant efforts to actually combat that spike in Treasury yields, but that is largely speculative. And I would like to say that I've highlighted while bulls have decided to view the jump in rates as a sign of economic strength that could lift corporate profits, there's been mounting concern over a potential pickup in consumer prices. And for Bleakley Advisory Group's Peter Bukvar, I would say, the Fed has put itself in a tough situation, and the only way out is if inflation doesn't rise any farther and stays below the 2% target. So I just wanted to read that whole thing out because I feel that it's pretty important. It's kind of vital to understanding this entire situation. Let's move on to something a little bit less broad. So this is going to be Peloton stock plunging 25% in the last month. So currently, Siegel rates Peloton stock as underperform. There is speculation that the reason the stock is slumping is just largely because people are becoming less concerned about the pandemic. It was a favorable pandemic stock because it sold at-home fitness goods, and as a result, it looks like people are kind of diving a little bit more into securities that might favor reopening, such as airlines and hotels and cruise lines and things like that. So that might be why Peloton is actually dipping, and I say that because Peloton actually did outperform its latest quarter, and it was seen as impressive. I would like to also say that people are expecting, to a certain extent, Peloton to underperform in the following quarters just because people are getting vaccinated and able to go to gyms. Again, though, Peloton's most recent quarter kind of negates that assertion. Next up, I have essentially mortgage rates topping 3% for the first time since July. This is pretty significant because the current average rate on 30-year fixed mortgage rates is 3.02%. And this would be the first time that America's most popular home loan has risen above 3% since July, and the fifth total week that it either increased or stayed the same. I would like to say that mortgage rates fell most of 2020 during the pandemic. That helped sort of influence the biggest boom in mortgage lending since before the financial crisis. And when rates hit 2.98% in July, it was the first time under the 3% mark in 50 years of record keeping. So that is very significant. Let's go on to the next one. So this is going to be Square is going to acquire a stake in Tidal, and Jay-Z is going to join the board. So Square said that it was going to pay $297 million for a majority stake in the music streaming platform Tidal. And again, Jay-Z is going to join the financial services company board. And I would like to read this quote as well. It comes down to one simple idea: finding new ways for artists to support their work. And this is from the founder of Twitter. So one thing that I'd like to say is that I do think that it's pretty vital for people to come up with new ways for artists to support the work, especially small independent artists, because it's pretty difficult without getting a label. And so, I do think that there is potential there. Let's go on to this. So Cathie Woods' ARK ETF has been, exceptional. It's outperformed almost everybody. She's become Wall Street's one of the hottest fund managers since Peter Lynch or Bill Gross, it says. But now, ARK has essentially erased all of its 2021 profits because they were largely invested in speculative tech stocks, and those have plunged in recent days. So that is something to notate. Some people might say, well, now it's on a discount. Some people might say, well, I need to sell. Next up, so basically Goldman did say that they were going to match Citigroup in actually becoming net zero insofar as their carbon emissions. So that is good. It looks like this is going to be a growing trend amongst companies. So any stocks relative to that trend might bounce up a little bit. Next up, the COVID-19 baby bust this year. There was a lot of speculation that there was going to be a baby boom, but as I thought, just because of A, concerns about, actually money during the pandemic, and B, concerns about having a baby or being pregnant during a pandemic, did actually lead to what they called a baby bust instead of a baby boom. So a year into the pandemic, early data and surveys point to a baby bust in many advanced economies, from the US to Europe to East Asia. And essentially, women are having fewer children than expected, and fewer than average, actually fewer than the replacement rate in the US. And it also says a combination of health and economic crises is prompting many people to delay or abandon plans to have children. Demographers warn the dip is unlikely to be temporary. That's pretty important to notate, especially if the pandemic and its economic consequences drag on. One thing to notate here is this would mean fewer younger people to support an increasingly old elderly base. And again, any stocks relative to that would be vital. Next and finally, let's go ahead and talk about this. This is concerning to say the least. But the U.S. federal debt is going to grow more than double the size of the economy in 3 decades. So this is said to increase the risk of a new financial crisis. And this is coming straight from the Congressional Budget Office. So debt will be equivalent to 202% of GDP by 2051 from 102% this year. So it's already over 100% for this year. But that's all for today. I felt these to be the most relevant stories. But do come back tomorrow. I'm going to make another video. Other than that, I hope you learned something, and certainly have a great rest of your day.